Hey, it's Tom here and welcome back to the channel. So just last night I put up a post on my community page here on YouTube and asked for your questions for a Q&A video, and this is that Q&A video where I will attempt to answer your questions. Now, we did get quite a few questions, so I don't think I'm going to be able to get through all of them, but I will do my best. If you did ask a question and I don't get to it, I apologize, and if you do want to ask a question for a future video, turn your notifications on for any community page posts that I make. So that's typically where I go and ask questions kind of a day before I film the video. So before we get into that, we do have a sponsor for today's video, and today's sponsor is Sharesight. Now, Sharesight is the application that I personally use to basically track the performance of my investment portfolio. For me, I earn basically all of my money in New Zealand dollars. I then go and invest that money in a few different places around the world. So in New Zealand, in the US, every now and again in Australia, and that creates some challenges in terms of trying to reconcile my portfolio and see how the returns are going. So I don't just have the stock price changing from the stocks I've bought into. I also have exchange rate fluctuations. I also have dividend income, and I'm also sort of constantly contributing new cash to my portfolio. So trying to figure out what my returns actually are is quite a tricky process, but Sharesight makes that very simple for me. And from Sharesight, I can also get my taxes done from my sort of stock market portfolio side of things very simply. So I can extract some reports from Sharesight which show things like dividend income and capital gains and stocks that I've purchased and sold through the year and all that sort of thing. I can give those to my accountant, and it makes tax time a lot easier than it would be otherwise. So you can actually use Sharesight for free if you go to the link sharesight.com/investingwithtom. But if you want to upgrade to get better tax reporting, to have an unlimited number of holdings and all that sort of stuff, using that link will get you 4 months free off of an annual subscription. So head over to that link. It will be down in the description below. I'm a big fan of Sharesight because it actually also integrates with the two brokers that I use. So it also sort of updates my portfolio constantly, automatically, anytime I make changes. So they are the sponsor for today's video, but for now, let's get into your questions. Okay, so first question is from Karan Gunani. Shout out to Karan from Punch Card Investing, one of the 5 of us on that live stream channel. Karan asked, what would your dream house be like? Yeah, interesting question. I'm actually sort of house hunting at the moment. I don't really have aspirations to live in a big flash mansion or anything like that, but I would love to live somewhere relatively close to the water, relatively close to the ocean, which isn't particularly hard to achieve here in New Zealand, but if you do get too close to the ocean, you will have to pay up for that. And I don't know, somewhere kind of quiet as well. I'm not a huge fan of living in big kind of hustle and bustle cities. So outside of that, I really don't have too many requirements, but that's where I would love to be at some point. Next question is from Ben Scott. Have you done any analysis on Briscoes, BGP NZX? Being from New Zealand, you must have seen the retail sector going to the moon. And if you haven't, have a quick look and give us your first thoughts. Cheers, dude. Keep the work up. Thanks for your question, Ben. I really don't know if the retail sector is the most likely one to go to the moon, but I have taken a brief look at Briscoes. And there was really nothing that jumped out to me. They're growing revenue at earnings at sort of single-digit compounded percentages as far as I can tell, and it's trading at 18 or 20 times earnings. So just looking at those couple of surface-level indicators, it's not really something that's that attractive to me. I've done several videos on Alibaba recently, for example, and that's a business that's trading at about 20 or 25 times earnings, and it's growing at like 20% a year. Will probably not grow that fast out into the future, to infinity, but that is a much more attractive proposition to me personally. So if I'm missing something obvious with Briscoes, I would love to hear that down in the comments below, but that's sort of my current thoughts on the whole thing. So thank you for your question. Okay, next question is from Uzier Abdullah. Apologies if I'm butchering your name. Asset allocation for people of different ages. So interesting question. I really can't give recommendations or advice to people of specific ages or to anyone for that matter. But I guess for the most part, there's going to be kind of a couple of different phases to your sort of financial life. So if I take my scenario at the moment, I'm 26 years old and I'm very much in the sort of accumulation stage. I'm still working full time. I'm trying to build up a bit of a nest egg, and I'm nowhere near retirement right now. So for me, in terms of asset allocation, it is very growth focused. So a lot of my portfolio is in businesses, in the share market, stock market, whatever you want to call it. Shortly, it will hopefully be in a bit of real estate as well. But it's very much growth focused, and it will be for probably the foreseeable future. At some point, hopefully I can kind of stay growth focused almost forever, to be honest, and hopefully I can live off dividend income or something from that portfolio. But for a lot of people, they're probably not going to get to the stage where they can stay growth focused forever and continue to stomach volatility through retirement and that sort of thing. So over time, you'll see people sort of shift to more defensive strategies. But it's very much going to be kind of different for every individual out there. So those are some initial thoughts to maybe get you thinking about it. So thank you for your question. Next question is from Sten Hemming. How would you start investing with a small capital, say $10,000? How would you diversify this or not? I'm just starting with investing and don't want too many stocks, around 6 to 12. However, don't want to have small positions. Would you go all in with the 10K and then save up and wait for another opportunity? Yeah, again, this one is going to be a little bit personal preference. When I was sort of at that stage, I think I owned like an ETF and 2 or 3 individual stocks, something like that. But yeah, it's really going to be personal preference and what you really want to do. So there's a bit of a trade-off. Obviously, the fewer stocks you have, the less kind of tied to the performance of the overall market you're going to be. So that gives you a better chance to outperform the market and also gives you a higher chance of underperforming the market. And it's probably going to give you a little more volatility, or potentially a lot more volatility than the S&P 500 as well. So if I were first getting started, again, I would probably buy into some sort of index fund just to get a feel for how stock prices even move around and how I feel emotionally about that, because I know when I first started, I bought an index fund, bought a couple of individual companies, and then I was like looking at my phone every 5 seconds to see that, I'd made or lost $2 in the last 10 seconds and all that sort of stuff. So that's probably where I'd start out. If I was maybe further into this in terms of like education on picking individual companies and analyzing financial statements and all that sort of stuff, maybe I'd buy 1 to 2 stocks, something like that. But please don't take that as investment advice. That's just kind of where I've landed on the whole situation. So thank you for your question. Next one is from Avier. Do you ever plan on investing in countries other than the US, Australia, and New Zealand? Also, do you ever plan to share your portfolio publicly, maybe through an app like Iris? I must say I haven't heard of Iris. But in terms of investing in other countries, I'm pretty open to investing basically anywhere. So up until this point, that's only been the 3 countries that you mentioned. So New Zealand, Australia, and the US. I do have a position in Alibaba, which is a Chinese company, but it was bought in US dollars, listed on the New York Stock Exchange. So that's kind of where I have gotten to at this point, and it's really just been from the opportunities presented to me. If I found an investment that looked attractive in the UK or in India or somewhere else, as long as I have access to that market somehow, I would certainly be open to buying into that. So thank you for your question. Next one is from Michael Slade. Based on your video on Superinvestors' early posts on Value Investors Club, what do you think is the best way to find seemingly obscure companies the market has missed for yourself? Is it ever realistic to think a part-time retail investor could spot an undervalued Mexican poultry company, for example, as Michael Burry did back in the day? Yeah, I think it's possible. I think it's really about how many rocks you can sort of turn over in your investment research. If all your investment ideas are just coming from like a 13F, for example, from a super investor, you're obviously far less likely to be able to find these individual companies. But every now and again, something will pop up, particularly if you're sort of starting with the A's and working through a lot of individual companies, which I must say I haven't personally had a lot of time for the last year or so, but it's something that I would like to pursue more. And yeah, I mean, in my personal experience, even without turning over a huge number of rocks kind of obsessively, I've had maybe one or two of these types of things pop up every single year, either from news that's come out or even from a subscriber sending me ideas. Yeah, I do think it's possible to find those types of companies, and the Value Investors Club itself is a great way to find these companies. You don't necessarily have to be the first one to track it down. If someone on the Value Investors Club has done that for you, then that's kind of interesting as well. You know, I've had subscribers send me stocks that are genuine PE of like 1.5 to 2 ideas. I've also had subscribers send me net investment ideas and all that sort of stuff. So I guess that's a bit of a privileged position for me to be in personally, in terms of having this constant flow of ideas. But I think that if you spend enough time looking at enough companies, probably particularly smaller companies, you can find these things from time to time. Okay, next question is from Harsh Jain. Since you are an acolyte of Mr. Pabrai as well, would you consider investing in the Indian stock market, and have you ever analysed any company here? Yeah, like I said in previous question, I would invest pretty much anywhere if I had access to the market and if the opportunity was attractive. The only Indian company I've ever taken a really close look at would probably be Rain Industries. That is because Mohnish Pabrai had purchased into it. At the time, it was really outside my circle of competence, and prices had changed a lot since Mohnish Pabrai had first bought into it. I think I was looking at it when it was quickly up 8 or 10x, so I'd kind of missed that boat. It then went on to go down like 70%, and I think Mohnish Pabrai even bought a little bit more, and it's up again a little bit. So that one's been a pretty bumpy ride, but that's probably the only Indian company I've ever seriously looked into. I have looked a little bit at Graphite India, just sort of in my work around graph tech, when, again, Mohnish Pabrai bought into graph tech in the US, but I'm yet to invest in an Indian company. So, again, thank you for your question. Tyopa, again, apologies if I'm messing up your name there. Does seeing so many super investors buy Baba increase your conviction? Yeah, it does. If I'm being honest, I'd like to say that I can do all the work and think independently of what those super investors are doing and come to my own conclusions, which I have, and I'm sort of comfortable with the position that I've got in my portfolio with Alibaba at this point. But yeah, it is certainly comforting to see a long list of super investors in Alibaba and a growing list of super investors as well. So yeah, it's good to be invested alongside some of those people. Absolutely. Next question is from QE. How low will Baba go? Yeah, your guess is as good as mine on that one. I have no idea. If it does go down, and we spoke about this a little bit on the Punch Card Investing stream yesterday, if it does go down, Alibaba are actually doing a lot of share buybacks. So if you're a continuing shareholder in Alibaba, a drop in stock price would actually directly benefit you. Like, you would end up with a larger proportional ownership in Alibaba if that were to happen. So kind of similar to what Buffett was talking about with Apple a few years ago, where he'd bought into Apple and the stock was actually down from where he'd purchased it, and he was saying, I'm directly benefited by the stock price going down because Apple are doing so many buybacks. It's sort of similar situation, and we know how Apple worked out. That's not to say Alibaba's going to do the same thing, but we'll wait and see and see how that one plays out. So appreciate your question there. Next question is from Andrew Brown. Shout out to Andrew. Go check out his channel if you haven't before as well. When friends and family talk to you about investing and ask for your advice/opinions, what do you do? So in almost all cases, I basically suggest buying an index fund to friends and family, because for the most part, there may be some exceptions to this, but for the most part, a lot of them don't particularly care about analyzing individual companies or doing that sort of thing. So when we start talking about individual companies and I go into sort of that level of detail, that probably sort of puts them off a little bit, I would say, from looking at individual companies. So I think indexing is a very great and kind of simple way to go for most people, and that's kind of where the conversation has typically gone with family members as well. But it's an interesting one to people have seen that I've got the YouTube channel and I'm getting asked about this kind of stuff more and more in my personal life. So that's kind of where I've gone with it to this point. Next question is from Carol. How do you judge / evaluate whether the info given in an annual report is good or bad, or if it's trustable or not? And also, after you've seen the annual report as well as the financials, how do you come to a conclusion that this is the company that you'd buy? Thank you and have a nice day. Well, thank you for your question. So in terms of, I guess, basically trusting the accounts and the annual report is kind of what this is getting at. It varies a bit with different countries. So this is one of the major advantages of investing in a really highly developed market like the US, is that the financials are audited. The CEO is very much putting themselves on the line when they sort of sign off these annual reports and so on. So I don't really think there's much that you can do further from that, particularly with US companies. I think you can pretty much take the numbers for what they are. That doesn't mean there'll never be fraud, in US markets or anything like that. But if you're investing in the States for the most part, you're going to be able to trust, I think, a vast majority of numbers coming out. If you go to China or India, I think the scenario probably does change a little bit, and that's why you've seen people like Monish Pabrai, when he invested in India for a few years there, he was very much interested in talking to management a lot more than he was with US companies, just to try and get a feel for the actual people and see if he can sort of figure out those individuals. Of course, we don't have the luxury of that necessarily as individual investors. But you can get a feel for the people auditing the reports and whether they're reputable companies and that sort of thing. But certainly, I guess the further that you go down the spectrum of less developed markets, the more of a risk that this probably does become. And in terms of coming to a conclusion on whether it's a good company to buy, that is a fairly lengthy process in many cases. Basically goes through understanding and trying to wrap my head around the business and kind of the key drivers for future growth and profitability and so on. Does it have some sort of competitive advantage? What do I think of the management team and how they're currently performing? And then what do I think the business is worth intrinsically? So that's a rough kind of overview, but that's the general process for me. Okay, next question is from Dr. Suniti Mishra. Again, I hope I'm pronouncing your name correctly. I'm new to investing, learning how to do valuation by DCF method. Where should I start and how to proceed further? My two most popular videos on the channel are about valuation, so I'd probably check out the second most popular one is probably the best to start with, the intrinsic value updated. That's sort of how I approach it, and then I would say, get out and try and run those sorts of valuations on companies that you are maybe a customer of and can understand quite simply. So that's probably the best place to start. Valuation is a little bit art, a little bit science, and it takes a bit of sort of practice and experience to try and be confident in the valuations that you're coming up with. But I think that sort of approach of learning the fundamentals and then applying it to a few relatively simple companies that you understand is probably the best place to start. So thanks for your question. Next one is from Gabriel. Hey Tom, would you talk a little bit about your goals with investing? We all know it's never about the money. There's always a reason behind each one of us, so I'd like to hear yours. Again, appreciate your question. The goal for me has pretty much always been to basically get to financial freedom as quickly as possible. It's never really been about buying like fancy cars or houses or anything, and I'm certainly nowhere near that point yet. Like, I'm still very early in the sort of compounding journey, I suppose, with my investing. But it's always been about just having freedom and having choices, and as much as I enjoy my day job, it would be great to have the ability to or have the choice to not continue doing the day job, or maybe dial back on it a little bit if I wanted to, for whatever reason that might be. So that's always been the main driver for me, and I've just kind of fell in love with the whole idea of understanding business and trying to compound money and so on. So it's certainly not about the money. It's kind of freedom that we're after at the end of the day, but of course money is a very important component of being able to achieve that. So that's where I'm at with that one. Next question is from Zacharias. Have you taken a look at other Chinese companies such as Baidu? If so, do you think there is more risk associated with their accounting compared to Alibaba, which is held by multiple highly regarded investors? In terms of trusting the accounting, I really don't have anything probably worth saying on Baidu specifically, but I haven't really taken a look at that company much. I've looked a little bit at JD.com and I've looked a little bit at Tencent, but man, even trying to get my head around Alibaba is a bit of a full-time job, so that's taking up sort of most of my time right now. So thanks for your question. Next one's from Jonathan. Assuming a 25% tax rate on profits, is it better to hold a stock long term, or if volatile, sell the tops and buy the bottoms? Yeah, I guess theoretically, if it's really volatile and you can tell exactly where the top and bottom are, then you're best to probably pay the tax and sell at the top and buy at the bottom. I guess as a practical matter, picking where the tops and bottoms are is not an easy thing to do. You can calculate intrinsic value, of course, and give yourself a rough idea of where the business is currently valued in the market relative to where you think it should be, and sort of move around that. But for the most part, I don't tend to do anything like that. There's basically two types of companies I invest in, sort of 50-cent dollars, which if they appreciate to $1, I just sell automatically. In which case you maybe could just sell them automatically, and if they get cheap again, maybe you buy them back and do that sort of thing. But that's not really something I've ever done with a company that I can think of yet, but there are companies that I have sold that if they got cheap enough again, I would buy them back. And with the sort of higher quality businesses, the long-term compounders, I have basically no plans to sell those ever unless the price gets egregious or I've got much more attractive opportunities elsewhere. But I wouldn't simply sell it just because I think it's going to go down in the next few months, or I wouldn't buy it just because I think it's going to go up in the next few months either. I would only buy it if it's at a discount to intrinsic value and I think the returns for multiple years look attractive. So thanks for your question. Next question is from Mert. Doesn't it make more sense to invest in small cap stocks if you don't have millions? Yeah, this is an interesting one. I think there's different perspectives on this. So someone like Investing with Frank here on YouTube, who again is part of the Punch Card live streams, is very micro cap focused. So he is following small companies that are potentially more likely to be mispriced and are less closely followed by professional investors and all that sort of thing. I personally am basically market cap agnostic, so I will invest in a company with a really tiny market cap, or I will invest in the biggest company in the world. If I think the future returns are attractive in either of those cases, then I'm happy to kind of make that bet in my portfolio. So I think it probably is more likely that you find big mispricings in smaller companies, assuming that there's not some big market crash going on generally, in which case you can probably find mispricings all over the place. So yeah, I think it's a reasonable place to start, and I don't think millions is the threshold either. I think it's probably tens or hundreds of millions that you have to get to before you really get restricted on being able to invest in very small companies. So for the average investor, I think you can probably buy most securities around the world. Frankly, I don't think you're going to run into size issues until you get to very, very high levels of wealth by most people's standards. So thank you for your question there. Let's do maybe two more questions, and then I think we might just about be out of time. So question from Bart: how much capital do you manage? That is one for me to know and you to maybe one day find out. I don't know, probably not though. But I can tell you it's nothing crazy. Like I say, I'm pretty early on in the grand scheme of things in the investment journey. I've only been doing this for about 4 years, and the good news is I'm managing more than I was last year, and more than the year before that, and the year before that. So we're heading in the right direction. But I don't feel like I should be disclosing any numbers on YouTube. So thanks for your question, and let's make this the final one. So from Yugal: how did you learn to read and understand financial statements? Book suggestions. Yeah, so a couple of ways, I guess. In my day job, I do a little bit of looking at financial statements for particular businesses, which has been quite helpful. I don't have a formal finance background or anything, but trying to get a feel for sort of the mechanics of how real life business results flow through financial statements and how we can use financial statements to then work back and interpret real business results has been quite helpful. Actually did read a book, this one, with the thrilling title Warren Buffett and the Interpretation of Financial Statements. It's a little bit simplified and probably a little bit cheesy in terms of like, Buffett looks for this type of number to identify that a company definitely has a moat. So it's probably a little simplified in that kind of aspect, but that book literally works through like line by line of a financial statement. So sort of 1 or 2 pages on each kind of thing, and talks you through, what these items mean and how you can interpret those numbers with real companies, and what Buffett might use to identify competitive advantages and so on. So that is it from me for this one. Thank you all for your questions. Like I say, if you're interested in asking a question in a future video, keep an eye on my community page for those Q&A posts. Try to do one of these around once a month or so. And if you're interested in checking out Sharesight or getting 4 months free on an annual subscription, you'll need to go to the link here, sharesight.com/investingwithtom. But that's it from me for this video, and I will see you in the next one. Cheers.